thing.
That's something.
So I guess that's
Wow.
pure providence and a lesson in not being greedy, right?
And tells you just how resilient that wheat can be. Yeah, that's
Yeah, yeah, exactly.
amazing.
Exactly. I'm having a hard time getting on Teams, Bobby. I'm on my phone, so if you don't see
Okay.
slides, I'll wing it. And
Okay.
my computer updated last night, and I'm having it's a whole new world right here for me.
I hear you. Well, I got us recording, so we'll go ahead and get started this
Okay.
morning. We're gonna jump off with Dr. Robinson. Again, we appreciate everybody that is on this morning and for our monthly uh, grain, cotton, livestock marketing update. And as usual, it's a pleasure to be on with you guys, and we'll get started. Dr. Robinson, if you want to take it away, we'll uh, turn it over to you.
All right. Uh, we're getting there. There we go. All right.
All's good.
Thank you. So let's talk about the cotton deal. We have, as we do every month, we get a fresh set of supply and demand numbers for the U.S. cotton crop, and we got it for February, released by USDA last week, and there were minor changes. There were no changes to the supply side of the balance sheet, and I'm looking at the right-hand side column here, which reflects the supply and demand numbers for the 25 crop, the crop that's in storage probably right now. And they didn't change anything with planted acres, harvested acres, yield per harvested acres. So the production number of 13.92 million bales was unchanged. That that to me is not to be. It's very expected that there'd be little changing here. The data we get from USDA indicates that probably 98% of, if there is indeed a 13.92 million bale crop out there, like USDA forecasts, 98% of it's been ginned and 98% of it's been classed. So, we're zeroing in on the final number, if not already there. So it doesn't surprise me that they didn't tinker with the supply side. On the demand side, they made one adjustment, and that was kind of a bearish one or a disappointing one. They lowered the forecast of exports from 12.2 million down to 12 million. That is, they cut 200,000 bales of projected U.S. exports. And at the same time, they raised Australia, who's one of our major competitors, they raised Australian exports by the same 200,000 bales, and they raised Chinese imports by 200,000 bales. So it kind of very much appears like they just said, all right, we're going to take what we thought was coming from the U.S. and credit it to Australia. And it's like Australia is taking market share, export market share away from the U.S. Um, for those Chinese imports. So that's disappointing. The bottom line of all of it was ending stocks. They rose a bit. They rose from 4.2 to 4.4. That is, that 200,000 bales of fewer exports went right to the bottom line and added to the ending stocks. But it, you know, compared to last year, it's in the same ballpark. So it's basically it's an instance of not more of the same. It's more of the same compared to the year before. And when ending stocks are similar, then it's the expectation that prices would be similar, or the range of prices would be similar, which is what we've been getting. We've been getting prices that ranged from the low 70s to the low 60s, and that's somewhat similar to the price range back for the 24 crop. So we're getting more of the same. One of the reasons that that USDA cut U.S. exports is explained by this chart that I'm showing here. This is weekly export data for U.S. cotton, indicated in the zigs and zags up and down of that blue line there. That reflects shifts from 100, 200, 300, 400,000 bales per week. Anything over 300,000 is a good week of export sales. Go over there to the right-hand side of this picture, and you can see we've had a whole bunch of export sales numbers. We've only had three or four above 300,000, and then here about 3 weeks ago we had two in a row we had one that was over 400,000. That kind of led me to think, if you looking at again at the right hand side of this chart, that uptick over 400,000 was, I'll confess, I was creating hope that U.S. cotton exports were going to pick up more of a long-term sustained thing, which would be interpreted as a demand recovery. Basically, we're waiting for Brazil and Australia to run out of supply so that the market would turn to us. And that's how I was looking at this uptick uh, from 3 weeks ago, the marketing year high. But since that's happened, the weekly sales since then have been kind of so back under 300,000. So what we need is a whole bunch of ticks, 1, 2, 3, 4. We need 6 weeks in a row of up here above 300,000 to convince the market that a demand shift is happening. We need to see that, and it hadn't really happened yet. So we'll still have to wait. So let's talk about 2026, and then I'll yield the floor. There's differences of viewing what might be planted in 2026. The economist way of predicting planted acres is to look at relative prices. This is a chart that plots the ratio of corn prices to cotton prices, which historically has explained pretty well the level of cotton prices that have been planted. Just the long and the short of it is, when cotton is richer than corn, reflected by a, a lower price ratio on this chart, then we plant more cotton, and vice versa. When corn prices are richer or higher relative to cotton prices, we tend to plant lower. And given what the prices are right now, Dr. Welch will talk about the corn market in a second, but given where prices are right now, I would expect, based on history, based on this chart, that we'd be planting somewhere around 10 million acres, 10 million. But there's other ways to forecast planted acreage, and that typically comes in the format of surveying industry people or growers. So Cotton Grower Magazine is already out with their survey of a little bit over 9 million acres. Cotton Grower Survey is, they'll call up experts, they'll call up industry people, they'll call up people like Josh McGinty and say, are acres going to be up or down in your opinion, in your region? So that's the basis of that survey. And it was a fairly low number, just a little bit over 9 million acres. Then the National Cotton Council survey came out a week or so ago. That's based on a larger sample of growers. And the Cotton Council survey came in reinforcing a pretty low number. So we've got to consider the fact that actual cotton plantings may be lower. Now, there's still time. Both the Cotton Grower Survey and the National Cotton Council Survey are early season, and there's time for adjustments based on weather, based on price movements, and that's what this chart shows. Is that basically, given the planting intentions number from the council, which is the blue line. You can see it shifting up and down over its history. The final number, or at least as of June, what actually gets planted can shift as much as 6 or 7% above or below the council's early season estimate. Again, that's not criticizing the council number. That's just there's a lot of time between February and June for the market to change the intentions or for the weather to change the intentions. So there's still room for things to change, but you have to keep in mind the possibility because it's dry that raises possibility of we could plant a low number and abandon a lot, or we could plant an unexpectedly higher number and abandon a lot, or we could plant a higher number and have some timely rains come along and have more cotton than we were expecting. There's a number of different possibilities. This is just one. This is what I call my more of the same outcome, and that is basically plant a lot, plant more than what the surveys suggest, but plant an amount that's in keeping with relative prices, and then abandon 25% of it, which is a fair amount of abandonment, given all that dryness on the drought monitor map. If we do that, it's easy to pencil in a crop size of over 13.5 million bales. And then if demand is in the same ballpark as that it's been, basically it's pretty easy looking down at the bottom. It's pretty easy to pencil out another ending stocks number that is, again, in the same ballpark as the previous year. We're talking 4.39 million bales of ending stocks for the 26 crop, which is, again, very similar. Therefore, we expect more of the same in terms of prices. And so I've got some of those alternatives laid out here in bullets. The most bullish outcome would be if the council is right, or even we end up planting even less. Now that's fewer acres than history would suggest. It's fewer acres than relative prices would suggest, but maybe there's a shift going on, a statistical, what they call a structural shift. It's possible that we plant less, and then if we have healthy abandonment with a low planted acreage number, we could have a really, really tight supply. And if that was to happen, that would just shift up the whole range of prices. What I'm more likely expecting is the first bullet, and that is that we, like I say, we plant something in the neighborhood of 10 and abandon a whole lot of that. Come up with ending stocks in a similar neighborhood as what we've had. Depending on whether it's the more bullish outcome or the more of the same outcome, it's basically I expect prices to do what is shown here, following the seasonal pattern. I expect them to rise from the upper 60s where they currently are now. New crop ice cotton futures in the upper 60s. I expect them to rise over 70, and then probably peak in the middle of the season, and then sometime around June or July to settle into their seasonal weakness. So, Bobby, I'm going to leave it at that and stop sharing, and I'll be around for questions. Thanks.
Wonderful. Yeah, good information. I know that we're early in the season, so there's a lot of old information that comes up to help kind of see what the future might hold. But again, we appreciate you being on with us this morning, and hopefully the cotton market responds in a positive way this year. So
hopefully so.
Again, thank you. So I guess now we'll go to Dr. David Anderson and let him give us a little information on what the cattle market's doing and any of the good things that happening in that world. Looks good. I want to check your mic, Dr. Anderson. If you're talking, oh, there.
There we go. How's that,
Now
Bobby?
we can hear you, but we lost your slides.
I'm gonna open that up again. I had to close the sucker to get to my voice working.
Okay, good. You're all go now.
Yeah. Well, thanks. Oh boy, you'd think I'd know how to do this better. Well,
Technology always throws you curveballs.
I know it. Well, I think I get the pleasure of talking about a little bit more upbeat stuff when we get to talk about cattle prices and the cattle market compared to some of our other commodities. So, heck, let's jump right in. I want to hit about three things. One, the cattle inventory report that came out at the end of January. I'll pull a couple of things out of there that really I think set the stage for prices the rest of the year. And then a couple other things in here as well that we ought to be thinking about for the cattle market. You know, the inventory report came out. Everybody wants to look at the total number of cattle in the U.S. It was down about just under 0.5%, 86.2 million. And we get out here on the right-hand side of that screen of this chart. You know, I went back to the mid 60s here, and if you look at that, we really have a bottoming out of the cattle cycle right now, where we're really, you know, the larger declines early in the decade have given way to really just sort of a bottoming out and maybe setting some stage for growth in terms of total cattle numbers. That's everything: beef cows, dairy cows, cattle on feed, calves out there, wheat pasture cattle, you name it. That's all of them in this. I tend to like to look at the cow herd, quite honestly. It really is the kind of the productive engine of the industry. And we were down just over 1%. It rounded to 1%, another decline. And I would say, you know, the direction of change that we had fewer beef cows, I don't think was a surprise. I think the magnitude was a bit of a surprise that it was down that much. In fact, doing my pre-report estimates, and most of, I think, all the rest of the kind of livestock economists that do this, uh, we're penciling the cow herd to be up a little bit based on the really low rate of cow slaughter. Uh, and, but certainly it would appear we didn't bring in even nearly as many heifers as possible, and that left us down again. But again, what I would point out is really sort of a bottoming in this cycle but again, fewer cows. Now, what that sets the stage for is fewer cows, fewer calves, less beef production, and this extended out over for at least another year. And so, as we think about how long can we sustain these high prices, the last cycle we had a decade ago, in terms of the price side of this cycle, it ended pretty fast with a rapid expansion and sharply falling prices. This would suggest that we extend out these high prices yet another year. Again, I think high prices are on the horizon this year and next year, and so this lasts even longer simply because there's a smaller inventory. If we look at replacements now, if we were looking for some evidence of growth, ranchers did suggest in the survey that they're holding back a few more replacements. It was up almost 1%, but it's still at a historically very low level. Now, some of that's because we got a smaller cow herd, so we need fewer replacements. But again, I think that just really reinforces that the notion that these high prices that we have now for calves and feeders are attractive to make you want to sell those animals. And we haven't quite gotten to really a full-throated kind of run on holding replacements. And so again, there is some evidence here of some potential for growth, but boy, not a lot. So I think that really tells us our high price picture is gonna stay with us. Now, I do want to put this up here. The drought monitor, John mentioned it a minute ago. I'm going to compare 2 weeks because I think really this drought monitor, I think it's a really good representation of kind of where we are, but really where the risk is. And I will tell you, I think the map on our left is the week of February 10th. It's the last week of data that we had. And I'm comparing to the same week in 2011. And I think we all know what 2011 was like, 2012, that drought period. And if you look at the beginning, here we are early in the year, we have a much more ominous looking kind of drought monitor map than we did back setting up that year. A lot more, not only in Texas, but across the country, a lot more in that dark red, a lot more reflecting extreme drought. If you look at our big cow-calf states from Texas north, but also throw in, think about Missouri, which is our third biggest cow-calf state. Arkansas has a sizable number of cattle, as do these states in the South. And so, I think this is a pretty ominous map. And I think as this develops, as the year progresses, it's going to tell us a lot about where we can go in terms of the cow herd. And again, with implications for where we go in terms of prices. Now, this is the week of February 10th. We had this big storm came across. We'll see how that adjusts that map and see, are we getting some changes? And we should say, too, it's still, we're only halfway through February, so that's sort of we've got some time, but it's going to make this, our kind of spring rainfall patterns pretty critical for the cow herd and how we hold together going forward. Calf prices, my gosh, we recovered everything plus some from the kind of October wreck. We're starting out the year way above where we were last year. And it's pretty easy to point out that last year we continued to increase throughout the year. That certainly, we did not see a whole lot of our normal seasonal pattern of calf prices. And that's just related to tighter numbers and where we are in the cycle. But I think if we mark these forward, our available supplies of calves, kind of where we're going, I would argue we're going to have higher prices all year in 2026 than 25. And I think we're set up for higher prices in 27 than 26, just simply from the number of calves we're going to have available on the market. And again, as we look at some price projections, that assumes that the border continues to remain closed. So to Mexican feeder cattle. So again, high prices. We'll look at the fed cattle market. We've had a pretty nice little increase. We've got over 240 in the fed cattle market. Again, pretty rapid increase just in the 6 weeks of this year. Some very good prices. Again, our fed cattle slaughter is down, particularly in the last several weeks. I think that's fueling those prices higher. And we should consider we haven't gotten really to our kind of normal spring rally and grilling season demands yet. And so we have that springtime ahead of us. And if we mark forward number of cattle on feed, tighter supplies. But underlying these prices, we talk a lot about the supply side, but it's really the demand side that's allowing these prices to get into this territory. And that's because beef demand continues to be very good. I think consumers continue to see beef as providing good value for the dollar, and they keep buying. We would not have these kinds of prices on supply alone. And so, we may talk about supplies more, but in the back of our minds, this demand picture, I think, is tremendously important for prices in this area and for prices to remain higher. One of the things that's going on, I was in a conversation with a reporter yesterday they wanted to talk about declining, really the health of the cattle economy all the way through the supply chain. And she asked some questions about cattle numbers. But one of the things I came back to on this is to remind us, if we look at dressed weights, our steer dressed weights, we're offsetting cattle numbers with just plain more pounds. Those last few pounds take a lot more feed. So from a feed use standpoint, I think this helps offset our declining numbers in terms of feed use, in terms of the corn and grain sorghum market. This helps that complex. But again, more weights, we're making up some pounds. But that brings some problems with it, but it is some more pounds of beef, and that kind of helps this overall supply situation. I mentioned cattle on feed. We're going to have a cattle on feed report comes out at the end of this week. I think I'm on the, I said this, I think Monday on something. I think in the pre-report estimates, I'm out there on the lunatic fringe. I've got placements down a little over 7%. Boy, that's sort of where the statistics came out for me, but I think that's too large of a decline compared to a year ago, but we'll see. But I think that's too large of a decline, but we still ought to expect placements to be lower. Marketings were down about 13% compared to a year ago. That leaves us with cattle on feed down a good 2% compared to a year ago. So really continuing declining numbers of cattle on feed. And quite honestly, if our weights were back down where they normally used to be, implying fewer days on feed, we would be seeing a much larger contraction in the number of cattle on feed. We're keeping numbers up by having them on feed longer. And that's part of getting the heavier weights. So let me say one other thing. I want to talk about Argentina for just a second. There was a lot of talk in the news last week about importing more beef. A couple things about Argentina and how we might think about that in the, our import market. One is they eat a lot of beef down there. And so that because of their consumption, that does limit exports a little bit. But China is their biggest export market by far. At least 60% of their beef goes that direction. A relatively small part of their beef comes here, about 4% of their exports. But it's, less than 2% or so of our imports. Remember, the majority of what we import are trimmings. One question we might ask is, do they have those trimmings available to come here? Probably not a lot of muscle cuts come this way. They do export to other places. And so for those muscle cuts to come here, it's got to be at a better price. And so, I think it's really the total picture is not really very clear. There is some confusion about just how much will be subject to the tariff rate quota or be able to come in here at zero tariff. There was some unclear signals. Is it 80,000 metric tons or 100,000 metric tons? So, through 2025, through November, the data that we have, we imported about 51,000 metric tons from Argentina. That's a small portion of our imports. And even if we doubled that, it wouldn't be a huge contribution to our imports. So I think if we put this in context, it's probably not a lot of product compared to our total imports. And again, our big five are Australia and New Zealand. My green and orange lines. Australia is the red line. Green line is Mexico. Blue line is Canada. That dark line is Brazil. At times, Brazil is our biggest import source of beef. And I suspect that will remain the same in some months as it comes as they fill their TRQ. So even if we doubled imports from Argentina, they would at best be about our sixth largest import source, and they're about our eighth largest source now. So it's a pretty small number. I think it's worth keeping that in context as a lot of that gets talked about. They just may not have the available supplies to send here. So that's my last slide. I'll see if I can stop sharing. And I look forward to being with you here the rest of the time.
Again, Dr. Anderson, we're greatly appreciative of you being on this morning and giving us a updating what the livestock market's doing, and it is a good time to be in the cattle business. We can't dispute that. So again, thank you. As we move forward, we'll go ahead and go to Dr. Mark Welch and let him give us a little update on the grain market. So
All
go
right.
ahead, Dr. Welch.
Thank you, Bobby. Again, appreciate you putting this thing together. And yeah, talk about some things that I think may give us a little price direction as we're fixing to put some seed in the ground. I'm going to focus primarily on the corn market and the guidance it'll provide for, particularly in grains in general. And certainly pleased to see Wayne Cleveland on our call here this morning, and the insight he'll bring us, particularly in grain sorghum, and the perspective he brings for the grain market in general. I'm going to touch on grain sorghum just a little bit, but I'll certainly lean on his expertise for that one in particular. As we think about kind of what's shaping our grain price right now, and in red are kind of the old crop influences, and in green I've got what I think is the primary new crop price influence. First of all, last year's yield, exceptional corn crop across the country. We got the January crop report that showed a bigger crop. We had more acres, gave us a significant increase in supply than what we were anticipating. But on the other side, exports have been very strong and running strong in the corn market. Grain sorghum's taken off, and so it's good to see on those use categories in particular. As, of course, then Dr. Anderson mentioned, we have some concerns about fewer maybe hooves in the feedlots. But if we get them in there early, feed them longer, that's sure helping us on some of that domestic use, on the feed use. And there's some positive developments on fuel use. Maybe see adjustments to some underlying factors of support for ethanol, also for soybeans as biofuel, and that's helpful for the grain complex. So I think there's some good news at least supportive news on the demand side. We'll focus on exports. That's kind of where the real fireworks are right now. And then also perhaps some projections on what the size of next year's corn crop might look like. That's a kind of a recap of what the WASDE report shows month by month for the 2025-2026 corn marketing year. We start on the far left-hand side with the 24 crop, and then starting in May, when we get the first official estimates for the new crop year, the adjustments to all those major categories from beginning stocks, production estimates. We do import a little bit of corn, domestic use, feed, fuel, food, then our export markets, and then what the impact that has on ending stocks. And just kind of compare the first blue line on the left to the far blue line on the right. The big changes, first of all, in production, a much bigger crop compared to a year ago. However, we've also seen some creeping higher of domestic use through the marketing year, and exports have kept higher, such that ending stocks number has gotten bigger, hasn't just blown up on us. But note that it is above that 2 billion bushel mark, and that's a problem for price projections. We'll touch on that one a little more, highlight on that just a little bit. Talked about the strength of corn export sales. Typically, when we get about to the end of March, we would have about 79% of that marketing year total on the books. USDA raised the target last month from 3.2 billion bushels to 3.3 billion bushels, and we're currently standing at 73% of that target. So certainly well on pace to hit that one and maybe even take it higher. Again, very strong export sales numbers reported for corn. You can see the major market participants there with Mexico and Japan accounting for about half of U.S. corn export sales on a really strong pace. And then grain sorghum looks particularly encouraging when China came back in the market a couple of months ago. Of course, China's the last 10, 15 years has been our primary customer for grain sorghum, accounting for some 70, 80% of sales. Well, they're back up in the sales that have been reported to date of about half of our sales. Now going to China, we've been below the pace at this time of year. We kind of ought to be, but again, with China's strong purchases, we look to be well back on track to that 225 million bushels, which seemed pretty out of reach back this winter. Now looks like it's certainly much more achievable. And that's a very positive development for what would likely be the relationship between corn and soybean prices. I'll show a chart in just a little bit that shows how closely soybean tracks the price of corn. That makes a lot of sense. However, we do see years in which grain sorghum can trade at a significant premium, or as we're doing now, a significant discount to the price of corn. And much of that can attribute to the strength of export sales. So if we can maintain this kind of momentum and this kind of export demand for grain sorghum, that should put the price of sorghum in a much more positive relative relationship to the price of corn. So we're still going to follow, where corn is in our overall price trajectories, but on the specific, the sorghum basis looks a lot better in strong export sales years. And then if you look at just the chart of what that change did to us in the February WASDE, the only number that changed was to the exports, went from 3.2 billion to 3.3. And that, of course, raised total use by that amount, which took it out of ending stocks. Not a big change in our carryover, that stocks to use ratio or days of use on hand. We dropped from about a 48-day carryover to 47. So excuse me, what was a 50-day carryover to 47. Took 2.5 days off of that. Didn't change the farm price in that, so much of the grain's already been priced by the time we get into February. Sales at harvest, sales right after the calendar turns over into January. So it takes quite a bit to move the season average farm price at this point, but hovering around that $4.10 a bushel. And again, this just demonstrates the difficulty of getting much upward price movement, given these heavy levels of ending stocks. And you note those years when we've had stocks over 2 billion bushels, and the ones that jump out there right in the middle, 16, 17, 18, that was kind of right at the heart of that low price period we saw at that period of time. And then now the projections to back over 2 billion for this 25 corn crop. And actually, if you drill down a little closer, if we don't get that ending stocks number below 1.5 billion, that's still quite a bit of negative pressure on grain prices, particularly if our South American competitors are making a crop. And that plays into, of course, all of this as well. But to see that level of carryover in the corn market is a problem. And so as we look at some acreage projections here in just a minute, I want to focus on what the changes in acreage do to that carryover number. How much of a change does it take in our planted acres, given certain demand estimates that we'll leave unchanged between projections? What do we have to do with changing acres to get that carryover back down close below 2, first of all, and then back headed down toward 1.5. And so that's going to be a key feature of our price outlook for 2026. But when we keep that above 2 billion bushels, that's a pretty heavy supply problem to overcome. And then if you look at where we are in February, that $4.10 price, given a 47-day carryover, that's kind of about historically in this biofuel era, what be right on track. It makes a lot of sense that we would see corn prices about where they are. Actually, it's a little higher than kind of what they ought to be. And again, as we look at our projections here in a little bit, are we going to shift that carryover to the left, and maybe it's more friendliness in prices, or hold steady or go to the right, which would be, again, represent lower prices for next year. So that's where we're fixing to go. In addition to the big corn crop in the U.S., we had a huge crop in our foreign growing areas as well, all-time record high, and corn production just a magnitude higher in 2025 crop compared to where we have been, topping that 50 billion bushel production number for the first time in history. But if you look at a chart, and these are in million metric tons, there's our all-time record for this 25 crop of 1.296 billion metric tons, up from 1.229 billion metric tons a year ago. But it's interesting to note that even with that degree of production, it didn't keep up with use. We're not going to build ending stocks, even with the degree of increase we had in supply this year. We're still consuming more grain than we're producing, even at these extremely high levels of production. And what that does is, we talked about the days of use on hand creeping higher in the U.S. Those gold bars would indicate the degree of a carryover on the global corn market and how that's been trending lower since 2016. In that the stocks to use ratio, the days of use on hand globally, has been getting tighter and tighter each year. The market's not worried about it right now with an 80-day carryover, but it still reflects that I think we could see considerable market volatility with a relatively small change in corn supply, either weather or policy or other issues that would restrict the movement of grain. A small change in supply from a major production area, I think we would be poised to a significant price response, given that global corn situation, and same thing applies to wheat, has just been getting tighter and tighter. And probably one of the more bullish aspects, I think, of the corn market right now is what's happening in that soybean to corn price ratio. Dr. Robinson talked about the importance of that in shaping cotton planting. When you think about what goes up in the Midwest, much of those acres are going to swing back and forth 50-50 to corn and beans anyway. But the economics, when we see that corn price falling relative to the price of soybeans, and then that ratio getting higher, that would point to more favorable economics, more favorable returns for planting soybeans relative to corn, and vice versa. When you see a lower ratio, the number on the denominator is getting bigger relative to the numerator, and that would swing the advantage back to planting corn. That ratio of 2.39, that's where we stand at a monthly average right now in February. And of course, this is the base price setting period for our crop insurance products in the Midwest, and for much of Texas, it's still going on too. And currently that's standing at 2.39. Well, if you plug those prices into the budgets from our extension colleagues in Illinois and Iowa and Indiana and Minnesota, that would show the net returns from each of those crops, giving their extension budgets using statewide averages. And they're all red numbers. However, Iowa is the only state that if you plug those prices into their extension budget, shows a higher return from corn than soybeans. The others show that even though they're all a loss, a smaller loss for beans than for corn, given the prices that we're seeing right now. So again, I think that would support the idea that we will see that swing in acres in 2026 anyway, because we just swing those back and forth. We had a huge increase in 2025, but this might give that swing a little more momentum if we are seeing the net returns looking more positive for soybeans relative to corn. And that's exactly what the FAPRI organization, that's the Food and Agricultural Policy Research Institute at the University of Missouri. They do long-range forecasting, work with USDA and their pricing models. And this report came back out in September. And for 2026, we're expecting 92.8 million acres, now from 98.8. That's a significant shift. It takes 6 million acres out of the corn market. 92.8 is still higher than the 10-year average of corn plantings in this country. So to swing back to 92.8 would not be historic by any means. In fact, it just kind of gets us back closer to average and not quite down to it. So I think that's certainly a feasible kind of change that we could see, given 183 bushel yield. Kind of scroll on down, their use estimates that they're using are a little lower than 2025. Their ending stocks number, they would pull us down to 1.850 billion bushels. That's below 2, it's not 1.5, but it's a little friendlier 43-day carryover and a moderately higher season average farm price. Again, kind of nudging us back to that more volatile prices, which occur when around 40. But at least it moves us in a direction that's a little more friendly in prices. When USDA came out with their long-term outlook in November, they used 95 million acres. And using that number, they did use a lower yield. They're plugging in, at that time, plugged in 182. Same using their use estimates, again, a little bit lower than a year ago. They keep ending stocks above that 2 billion bushel level, carryover from a 47-day carryover to a 46. And again, where that kind of leaves us is just kind of right in that same ballpark of prices. USDA at their Outlook conference will release their, again, it's an updated projection. It's not an official estimate, of what they think acres of our major crops are going to be for 2026. That'll occur tomorrow and Friday. So I think the market will pay a lot of attention to what USDA's number, what are they going to plug in for that acreage number. 95 is a bearish number. That kind of keeps us about where we are right now in terms of the season average farm price relative to that kind of carryover. If we see something closer to FAPRI's number, I think that would be certainly more friendly and support more positive prices as we go through the rest of this winter and early spring. Back to that sorghum and corn price. These are national average cash prices going back over the last 20 years, and they just track along pretty close. But you will note that there are times when we see that significant discount of sorghum to corn, and also times in which we see that significant premium. And those premiums tend to be associated with those stronger export market years. So if we're entering back into that phase of time with grain sorghum relative to corn, that would seem to be supported by what's going on in the export market right now. So we'll see if that materializes and this we can break out of that significant discount that we're seeing across much of the country in our cash sorghum prices. Yeah, I'll wrap up with kind of where I think prices may be headed, and I keep talking about that upward trajectory of prices maybe in the spring. And much of that is built upon seasonal index patterns for the December corn futures contract. And so this is what, if you chart out on an index level, the seasonal pattern of the December corn contract. And that's using every year from 2003 through 2025 with a 1. I don't have prices on here. We've got an index. So 1 would be the date in which that in that year, the price hit the absolute high of the calendar year, and 0 on that index is the date in which we hit the low. And then are there patterns then around which we might expect seasonal highs and seasonal lows in December corn? The red line I highlighted just so last year's will kind of stand out. But you can see it's kind of a mess of trying to make sense of where corn prices are headed at a particular time of year. But you can create an index out of the index. And if you kind of average all those out, this is what starts to emerge. And that you see that typically we do see an upward price trend in the December corn futures contract from January to June. And we break that around the 4th of July. After we get the acreage report, comes out the end of June. What's the weather going to be as we're fixing to start tasseling, silking this corn, filling the ear. If the weather's going to be fine, which it usually is, then we drop those prices another leg down lower, down to a seasonal low in late September, the first part of October. We pretty well gained back everything we lost out of the January crop report when we had that big increase in supply, and that upward trend has kind of reestablished itself. I think we get a friendly number out of the USDA Outlook Conference. And if nothing else, a friendly number out of the soybean to corn price relationship. I think that does give us a degree of support of prices moving on through this spring. Just to highlight the importance of trade, we talk about how important that is for sorghum and its price relationship to corn. Trade matters a lot in all of these commodities, even in the byproducts like ethanol. It's a significant contributor to that supply and demand fundamentals when it comes to our major use categories. And you kind of see who our major partners are for some of those major commodities. But to put those in the table, and when we hear news and who the latest dispute is with, or the tariffs and counter tariffs that may be tossed around and back and forth, of course, primarily the country that jumps out first of all in 5 of those 6 categories, Mexico's in the top 3. Number 1 for corn, number 1 for wheat, number 2 for soybeans. Matters a lot. Where China's in there, they matter a bunch. They're big. They're only in 2, but they matter a lot. So again, I think particularly the concern now is around the renewal or the renegotiation of what used to call NAFTA, the USMCA, with our trading relationships with Canada and Mexico. Absolutely critical that we get something established there that maintains that favorable trade relationship that we have with our closest trading partners and closest neighbors. And I think this just kind of highlights the importance of that. So again, we've got a tough year margin-wise. The costs are high. The prices don't look favorable right now. The margins, if they're not negative, they're tight. So is the world grain balance sheet. I think that could give us some momentum if we have a weather scare, a production scare of any kind. But I do think of prices being moderately higher in 2026 than 2025, with, of course, weather, as well as concerns around trade. If we can get some of those things stabilized, a little more certainty and consistency in that trade environment, I think it'd be favorable for our market outlook. So, what I'm about to share with you today. Appreciate the time, Bobby, and I'll close this thing out.
Again, thank you for that update on the grains across the world and how plantings may be affected this year. And we know that grain farming right now is pretty tough. So appreciate you bringing that information to us. Next up, we have Wayne Cleveland, the Executive Director of the Texas Grain Sorghum Producers Board. Always a pleasure to have Wayne on. He brings a lot of really good information to us, and I'll turn it over to him, and Wayne, take it away.
I am trying to share my screen right now, so hopefully that works. Can you guys see it?
Yes, sir.
Okay. Can you see my slides here?
Yes, sir.
Okay. Thank you very much. And thank you for this opportunity, Bobby. I would like to mention before I get started for everybody to consider the Master Marketer program that's fostered by the Extension agent, Dr. Welch in particular. We're supporters of that for a lot of years. And I think if you see anything from any of the graphs that Drs. Welch, Anderson, or Robinson put up, is a confusion in the market sometimes, and understanding those markets is important. So continue that. Thank you. It's been an exciting year in sorghum trade agreements. I always kind of go back, his picture sitting above me right now on my desk. It's my grandfather, 1932, my other grandfather in 1890 on the Chisholm Trail. We've been at this a long time, and I always tell everybody that's the first piece of land we own right there in the center, and we're about to get that thing paid off 130 years later. So I'm going to move through these slides pretty quick. China is so important to us. It's really everything as far as market. China's on vacation right now. It's the Lunar New Year. It's equivalent to our Christmas vacation. This is where the horoscope animal comes up. I'm not a horoscope guy myself, but this year is the fire horse, Destiny. And the Chinese kind of lean into this. So they're going back to their provinces. You guys can read over there the importance of what's going on with the fire horse Destiny. The big one is the significance, is it is believed this year will bring opportunities for growth and require swift, decisive action. We hope that's buying grain sorghum and not putting lead in the air. So kind of odd that this is the year, and all of a sudden it comes out February the 17th was the first day of that. We go over to our export data real quick. You can see the far right. China's purchased about it says 1.3 million, but when it says unknown Destiny, I can guarantee you that is China. So you can see the discrepancy in that chart. You can see the total amount that bought is hoarded by China. Below that, you can see some of the FOB prices down there. With sorghum being at the bottom, we're probably around 225, 230 a ton right now. So you can see where we're pricing out in comparison to other grains, particularly corn in Brazil tends to be a big competitor with grain sorghum on the open market when it comes to feeding animals. So we're well above what Brazil corn is now. Argentine corn is important as well. Talking with one of our buyers from Spain last night, they think they're about to jump. You see Spain has actually bought quite a bit this year. They will continue to buy. Spain is an opportunistic buyer, but Spain has also had some technical problems with grain incoming. Again, this chart, can't show this enough, Mark. This time last year, man, we were hiding these charts. It was kind of embarrassing, and you can see that from September to November. Going into December, we were getting some hints. We went over in November, and they told us they were going to start buying. We had no idea that they were going to approach the amount that they bought so far. You can still see where we are relative to what USDA expects us to be. USDA's target is a little above 200 million bushels. We're still at 13% discrepancy. We need to sell a lot of sorghum to get to that 225 mark. You can see where soybeans are as well. Clearly, we've both been hurt as much as anybody in this process. Beans and sorghum, I think the price probably drives milo price a little more than it does bean price, because bean outlet, a little more technical numbers here from StoneX. I get these numbers from Ted Nelson over there. Again, you can see where we are for the current year. Milo, we're at about 30% of where we should be. So I'm sorry, 43%. And we need to move a lot of grain sorghum really quick. Just some key points. This is us in November. Mr. Shee, who's second from the right there, largest grain sorghum buyer in the world. We took some of our guys over, Chris O'Connor, and you guys can see Seth Stevens sitting there, met with the consular general, kind of pled our case, and then asked Mr. Shee to just kind of give us an idea of where China is. China is buying. It's the government only. 60% of all purchases are government, 40 are privates. Mr. Shee's a private, so he's not been allowed to buy yet. Internal corn price since we've been there has gone up right at $1 a bushel, and that's a bushel. That's not a hundredweight. So you can see China is in real press for grain right now. The way they store grain, the quality of their grain is terrible. Don't let anybody fool you on that. We think he'll come back in. Remember, there's no TRQ on sorghum. There's 7.2 million metric ton TRQ on corn. After that, it's 60% tariff. You can send all the sorghum in the United States there. The tariff doesn't change, which currently is 12%. We think it'll drop down to 10% at the Trump-Xi meeting coming up in April. We think it'll come back down to about a 2% value-added tax, which everybody has to pay. That's when these guys on the right are going to jump in. There is no sorghum on the market right now. We hold the only sorghum. Had a big crop. It unfortunately was sold by growers a little earlier, so you'll see merchants starting to clean up a little bit. You'll see some gains in the market, but you're also seeing this drive acres. From what I hear in the country, growers are more likely to plant sorghum this year than they have been in a lot of years. They can see the potential. Trade agreement framework with India, sorghum will be front and center in that agreement. It was in the announcement. India eats a lot of sorghum. They feed a lot of sorghum. They have a lot of poultry because their Hindu beliefs. They don't eat cattle. They eat goats. So you're going to see sorghum move to India if we can get this thing wrapped up. Just for growers, PLC's on an escalator. We think it's going to be around 465. We think that the average price received is around 365, so that's going to be $1 a bushel that you get on your PLC. That decision was made at the USDA office for you. Pretty no-brainer this year, so you're going to have about $1 a bushel. RFI is huge, currently in Congress, E10 to E15. There's a lot of different numbers floating around, but NCBA, it was kind of funny, was actually fighting the fact that it wasn't going to raise the price by $1, only 43 cents. So that's a substantial jump. If we can go to E15, I think you'll see probably another 1.5 billion bushels of grain leave the market. This guy on the right, again, he's changing all the rules. He's got his own satellite. He's watching us right now. And he's got 5 grain traders. And he's got 10 artificial intelligence computer programmers in his shop. And he is changing a narrative on agriculture in China. He has preached for years that sorghum's 100% the value of corn. He's quietly kind of cornered the sorghum market. And again, he's out there, and the Chinese believe, as they should, that sorghum's 100% the value of corn. So pretty cool stuff going on there. Again, no sorghum. You know, we hear about the Brazilian trade agreement, and I had our fellow do a little bit of study on the Brazilian shipments. They have about $1 billion loss in grain annually due to just bottlenecks, theft, transportation. 23% of the time, if you buy something from a Brazilian port, you get it on time. The other 77%, good luck. And the Chinese operate on just-in-time delivery. I know that was quick. I wanted to show you guys this picture. There's a lot going on there. This is about a week ago. There's water standing down there on our wheat. We got a little green grass. We got a gas pipeline going through us, which means gas is hot. And this cow laid down and had twins the day before. So I couldn't think of a more perfect picture, Bobby, to put up than this picture going on in Fisher County, Texas, and the sun is rising, which is a big thing. So again, appreciate the opportunity. There's my contact number. I'm in the office today. If you guys want to visit or want to give me a call or want to dispute some of my slides, call Mark Welch and he'll back me up on them. So it's a good time to be a grain of sorghum or a cow, right?
Yeah, well, a lot of good information there. I know you went through it kind of quickly, but it always is good to have you on and see what's going on with the sorghum market and some positive slides to end the day with. So yeah, getting the rain and all that's always is a blessing right now. So again, thank everyone for being on this morning. And as usual, it's always I enjoy this monthly update. So again, thank y'all. And till next time, unless somebody has a comment or question, we'll sign it off.
Thanks, Bobby.
Very good,
Great,
much help.
thanks.
Y'all have a
Thanks, bud.
wonderful day.
You too.